Hi, good morning, everyone, and welcome to another monthly Tobias Wealth Wisdom. My name is Edgar Collado with Tobias Financial Advisors, and I'm here joined by Matthew Sainholtz today, who's our President and Chief Investment Officer. Matt's a certified financial planner, a chartered financial analyst, and an enrolled agent. And we're going to be taking it back to basics today. We're doing Investing 101. Just to sharing with those that are new to investing, or just want a refresher, or if you want to learn some concepts and things that you can take back and share with a friend or family member. We're hoping that you'll get something out of this session. So the meeting today is going to be about 30 minutes, and we'll leave some time for questions at the end. There is a questions or Q&A box for the meeting. So if you have any questions throughout, feel free to type them in there, and we'll make sure we get to them at the end. If we're out of time, then we'll answer them after via email. So again, welcome, Matt, and thank you for being with us today.
Thanks, Edgar. Happy to be here.
So just to move on, just some standard disclosures. Obviously, the information that's being presented today is general in nature. It's not meant to be any specific recommendations to any investor. It's really educational. A little bit about Tobias. For those of you that don't know, we've been around since 1980. We are fee-only registered investment advisors that we manage actually over 450 million in assets for about 150 plus families. We really focus on individuals, high net worth individuals, and financial planning. It's really, I think, where we add a lot of value for clients and the people that we speak to. For those of you that aren't clients today, we do offer a free consultation. So if anyone's interested at any point, please feel free to reach out. But we're going to go ahead and get started here. Matt, I guess to get started, what are some of the terms, in the investing world that you're going to take us through today that you're going to tell us about?
Right, sure thing. So we have kind of a start of your first ever financial investing dictionary. We are going to capture terminology such as risk and return, the trade-offs, pros and cons between risk and return, a portfolio, which is your basket of money that you're now investing is a portfolio, and how we're going to build portfolios with a traditional stock or a bond. So we'll dive into exactly what a bond is and a stock. And then one of the financial planners' favorite words is diversification. And we'll dive into a couple different areas of diversification, whether that be a diversified portfolio at a higher level, or actually at a lower level of picking what investments to choose. And then we will finish up with a concept called rebalancing, and what that means in the context of a portfolio and managing your money to ultimately achieve your goals.
So one of the questions or discussion that often comes up, especially for people that are new to investing, they know what a bank is, they know what a CD is, they know that's really safe, but why wouldn't I or a new investor keep all their money, let's say, in a bank account or in a money market or something along those lines, which we know is either guaranteed or close to being guaranteed?
Yeah, so I think that will be our first terminology here, risk and return. So just like in life, investing, there's trade-offs. There are opportunities and times that it makes sense to keep all your money or a portion of your money in a bank or on the safest part of the financial world. And then there's other times you might want to risk, jump out for more return. So risk drives return. At the simplest form of it, risk, not having any risk limits the amount of return, and then vice versa. Having a lot of risk makes it for the potential for more return. There's just a wider range of outcomes when you add more risk to the puzzle. So as Edgar, as you're saying, if you're just want to be riskless or as less risk as possible, you just want to keep in cash. But there's the trade-off of that, a lot of times if you keep money in a CD or just keep it in your checking account, there's something that even though the balance will say still $1,000, if you put $1,000 into a CD, you might only get a very small percentage of interest, or maybe no interest in today's day and age. And so the return there is virtually nothing. And then there's the opportunity to have inflation, which is the ability of your dollars becoming worth less. I mean, there's a lot of people on the call today could probably remember maybe when you were a kid, when gasoline was maybe under $2 or even under $1, depending on how old you are. And so the risk there, but to bring it back together here, the more risk you take, the more potential for reward, but also for potential loss. Always a good example is the type of job that you might choose. There's different ways to get compensated. There is your straight salary, and you know you're going to rely on that paycheck every couple of weeks, but you know it's going to be the same amount you're making than that particular year. Contrast that to a job where you might be on a commission type of schedule, where you're not, you know, that paycheck's not promised to you every 2 weeks, but if you have a really good year, you could maybe double what you might have been expecting from a job that has a straight salary. That is a great definition or a great example of the trade-offs between risk and reward. And that trade-off that I just used in real life and in a job situation relates to investing as well. There's on one end of the spectrum, there's cash and really safe CDs and treasury instruments. And on the far end of that is different types of speculative stock investments or speculative investments, where it's almost, in some cases, it's almost like playing the lottery, where you could put $1 on in a ticket or $1 on a really, really risky stock, and it could pay off huge, but at the same time, you could lose it all. So there's a trade-off, and the trick to investing is balancing the risk versus return of an overall portfolio. And I think we'll dive into that a little bit more, Edgar.
Yeah, so, you know, you hear about, obviously, if you watch any financial news, you know, they're talking about any, you know, equities and stocks, and sometimes they talk about bonds as well. I mean, how do I think about, you know, stocks and bonds relative to what you just said?
Sure. So traditionally, bonds are less on the spectrum of risky and not risky. Traditionally, bonds are less risky than stocks. Stocks are what you're going to hear in the news. Like you said, you're going to turn on your local channel or your favorite internet website. You're going to see the stock market was down 500 points today. And typically, stocks are more volatile than the bond market. And so when we're thinking about the risk-reward spectrum, it's kind of cash, bonds, stocks. And that's where those would fit on the spectrum. But let's take a step back for just a moment and see, you know, what is a stock? What is a bond? We take these terms and we kind of need to think about what that actually means. And so stocks, we'll start with stocks. So stocks could also be called equities, or equity in stock, or a similar, the same term. Think about a company that needs to raise money. And there's a few different ways to do that. You know, you have this great idea, but you need some investors to help move that idea forward into the marketplace, or to build your widgets, or whatever your great idea might be. So there's two different ways to really raise money in the financial markets. There's stocks, which the company will take money and you will get an ownership share for the stock. You'll now own a small piece of the company, you know, based upon how much stock you buy. Conversely, or separately, there would be bonds, which is actually a loan to the company. So a bond is more like a loan, where you say, okay, I'm going to hand a company, or even governments are also issuers of bonds, and say, okay, I'm going to give my money to the U.S. government for 10 years. I'm going to give them $10,000. That doesn't mean I own a part of the U.S. government, like if the U.S. government was issuing stocks, But the bond is more like a promise, like an IOU. And then every year you'll get a little interest payment. And after the end of the 10 years, you get all your money back. And so that's the difference between bonds and stocks. Also, another term, as we're adding to our financial dictionary today, is fixed income, which is another term for bonds, where just like it sounds, you get a fixed income, an interest payment, because you've loaned the company some money, and they will pay you back some interest or fixed income on that money until the maturity date, and then you get all your principal back, or all the money you gave them originally. A CD is very similar. It's a certain type of bond. Maybe you heard of CD, or certificate of deposit, from a bank, and so that is also a form of a bond where you can actually invest in a CD and get a little bit of interest back.
Are bonds, they're not risk-free, correct? I mean, you can still lose your money, kind of like you were saying before, with a bond as well.
That's correct. That's correct. So in the spectrum, you have cash, then bonds would be a little more riskier, and then beyond that will be different levels of stock. And so, yes, that's a great question. So a bond, although they might be promising you a certain level of return or interest, there is some risk to that. So it's really a great point and great question, because certain bonds will pay you maybe 1% a year, where you could find a different type of bond that'll pay you 10% a year. And you think to yourself, well, hey,
That'd be nice.
why don't I get 10% a year? Sounds like a better return.
Right.
Well, there's more risk to that. There's reasons why that you're, as the investor, or as the loaner, the loan officer here to the company, you want 10% because maybe the company is not Apple or the established company, maybe it's a startup company. So you want to be, again, it's all about risk and reward. So if you're giving a loan to the company that's more risky, you want more reward back. And that's why a bond may not move up and down as much as the stock market, but there is still risk involved in a bond investment.
So you mentioned diversification before, and kind of like, can you tell us a little bit more about how to think about doing that, so that I have a good kind of balance, like you said before?
Yeah. So that's kind of starting to how to put together a portfolio, and how to put together a portfolio that'll meet your goals, and how to mesh up the composition, how we're going to combine cash, stocks, and bonds. Stocks have a very wide range of returns. They have more risk. They have more return outcomes. Over a short period of time, if you're looking at our charts today, on the left, over a 1-year period going back from 1950 to 2019, the green bar represents the wide range of what the S&P 500 or a basket of stocks could do. So in 1 year, a stock could be down, and this is real life historical data, a stock could have been down 39% in 1 year, or it could have been up 47%. And so there's a very wide range of returns between the riskiness with stocks and bonds. And then over a 1-year period for bonds, it's a little bit less. There's still a pretty wide variety of returns, but it's not as much as stocks. So what we want to do is put together, depending on your goals and how much risk reward you're willing to take with your money and what you're investing for, we'd want to take a combination of stocks and a combination of bonds and bring them together, and that will lead to a smoother ride as far as returns. So in our example here on the far left, if you meshed up 50% of stocks and 50% of bonds over this time frame, a 1-year return period, there could be a range of -15% to 33% in returns. The beautiful thing about investing and the beautiful thing about diversification is that over time, the more you stay invested, the better the return results typically be, and that wide range of variableness and how risky your portfolio is smooths out over time. And so if you're looking, now go to the far right on this chart, if you're looking at 20-year time periods, if you were able to stay invested for 20 years and didn't take out your money, the stocks are on a 20-year annualized basis positive, as well as bonds, but a 50-50 portfolio is also positive. If you just kept it together for 5 years, a 50-50 portfolio over this length of time remained positive. So we could get into the data all we want, and really the basic level is that we want to understand what we're investing for. Some people are investing for 20 years, some people are investing for 30 years, some people are investing for 5 years. We want to see what kind of time horizon you want to invest, and depending on how much risk you're willing to take, we'll mesh up some stocks and bonds into the portfolio. And one of my favorite kind of ways to think about this, Edgar, is that when I think about bonds and I'm thinking about stocks and I'm thinking about an old school fencing match, but a really kind of the pirate movies, having a sword and a shield. And if you think about your bonds as being your shield, so in the down markets, that's there to protect you when the stock market's very volatile during times of crisis, during times of upheaval. The stock markets are up and down, but you have your shield here, fixed income or bonds, to help level out storm here. And then you need some growth, so that's where your sword comes in with the stocks. And in certain time periods, you need both. You don't want to go to a battle without a sword and without a shield, so you need both. And there's different reasons to carry both.
So in the long term, if I had like a 50-50 portfolio, going back to what you said earlier, I'd be taking a lot less risk than having a 100% stock portfolio. But, based on these returns, they're not that far off, right?
Right. So it's just a matter of mixing it together and knowing that time is on your side. It's not about timing the market. It's about time in the market. You want to be able to, when you do invest, you want to be able to withstand some ups and downs. And so you have to be able to put this money away for some period of time. And to get the rewards of long-term investing, you have to be in the market to experience it. So it's not about always buying the low and selling the high. Sometimes it's just about being invested and being in the market over the long term.
So you mentioned Apple before, for example. Obviously, great company, very successful. Why not, just put, someone put all their investment in one company or two companies that they really like or that they know is really successful.
Right. Yeah. That particular company obviously has done well over the long term, and has just brought new products and new innovation to us consumers over the long term. But with that said, there's risk involved in only investing in one particular stock. And so concentrating all your risk in one particular stock is not a prudent, not a very smart way to go about investing your hard-earned money and your retirement money. Again, the building blocks of what we started with today: risk versus reward. There's more risk involved in investing only in one company. There could be business risk. Maybe that company has, if we think back to BP, maybe there's a major oil spill in the Gulf, and if you only had invested in that one oil company, which was BP, you got beat up pretty bad in that investment. There's also things like operational risk, where on the surface the company looks great, but what's going on behind the scenes and the financial company of that company, maybe there's not the right controls or right checks and balances. The perfect example for that is back, I guess it'd be early 2000s, and Enron. Enron was this huge company. And once kind of peeked behind the veil, the actual financials weren't what they said they were to be. And so if you were only invested in Enron, you just lost it all right there. And so we really want to see you, not only just put all your money into one stock, we'd like to see you put them into a basket of stocks.
Good, good. The other thing that I hear a lot about, Matt, is especially this year, right? So much news, so much talk about, the market and coronavirus and what's happening with the economy and stimulus packages. How do you stay sane as an investor? How do you not, make a knee-jerk reaction that's gonna, potentially hurt you in the long run? How should I think about that?
Yeah, that's a great question. I mean, this year has been there's so many different stories happening in 2020 with that can affect you emotionally. And so what you want to be able to do is come up with a disciplined approach and do it when you're calm, your financial advisor's calm, and you can work together to build a long-term plan that will help fulfill your goals. So you want to come up with a strategy that is, you set forth at the beginning, and then you want to monitor it and understand when is the appropriate time to make changes. There are many different studies that show that emotions get the best of investors. You feel that's just human nature. We're just humans. We feel good when things are going in the right direction, and we feel bad when things aren't going in the right direction. And you have a friend who I'm sure had a great day, and they think it's gonna last forever, and then maybe someone is maybe had some bad news in their life, and then they just human nature. They feel like bad things are going to happen even more so to them. And so you want to kind of get away from the emotional side of investing and really think about how to build. Once you have a nice mix of stocks and bonds, you want to build that portfolio in a way that you're not reacting to the news. And we are in the midst of a presidential election that has a lot of emotion tied to it. And so you can't just read the headlines. One thing that which makes the stock market and makes a bond market is the daily news cycle, and we have all these analysts and portfolio managers and a lot of people watching the market. So to take one piece of one headline or one economic number and say, oh, we had a great report on consumer confidence today. Let's invest all our money based on one piece of information. That's not a wise approach. So we want to make sure that we're keeping our emotions in check, and we have developed a plan in place to guide us in times of very much either in very great times or bad times, turbulent times. We want to make sure that we have something in place that we can stick to during the best of times and the worst of times.
Yeah, that makes sense. Do you know, one of the questions that we hear a lot as well is, so what should kind of like my allocation look like, or how do I think about the allocation? You talked a little bit about this, but I know, we have some clients that are kind of like on a very conservative portfolio or model, and then you have others that are kind of like an ultra or very aggressive. Like if I'm just starting out and maybe started my new job and I'm starting to contribute into my 401k, how should I invest?
Right. So typically, there's always exceptions to the rule, but typically as a younger investor, someone with more time horizon, that 30 to 40-year time period to invest, you can be more aggressive and you can have more of your portfolio dedicated to the more riskier part of the spectrum, which is different types of stocks. And so that would be one way to measure how aggressive or how much risk you're really willing to take, would be your time horizon. And so that's one thing. Another thing to consider would be we call it the sleep at night factor. You gotta be, this is your money. You know, some people are just wired differently than others, where you may be young, but you can't stand to see some variations in your returns as much as another person. And so that plays into it too. And because one of the worst things you could do as an investor is if we have some downturns in the market, that you sell out at a bad time. And so you want to be able to be comfortable in the portfolio, to be able to sleep at night, and to be able to withstand some ups and downs. But because there are going to be, that's the nature of investing. That's the nature of taking some level of risk. There's going to be some ups and some downs, but you need to be able to make wise decisions in any type of market. So those are a couple of ideas. Of course, we'd love to speak to you about setting your goals and finding your appropriate balance between stocks and bonds whenever that conversation might be appropriate for you.
So you mentioned rebalancing before. Can you tell us a little bit about that? And I guess it kind of ties into what you just said, right? About
Yeah.
the portfolio mix.
Sure. So we're gonna make up an example here of somebody who's probably in the middle of the road here. They're not want to be too aggressive. They want to be too conservative. They want to be somewhere in the middle of a balanced portfolio, depending on their mix. So let's say we decide that we want to be in 50% stocks and 50% bonds with this particular investor. And so that's going to be their target allocation or their original asset allocation. And so here we are. We put our money into the markets and different bond markets, and we're at 50-50 as far as stocks versus bonds in a portfolio. Let's fast forward 3 years. Let's say, okay, the stock market's been doing pretty well the last 3 years. The economy's going strong, and stocks have been going up. And so fast forward 3 years from now, take a look at your portfolio. You say, okay, well, stocks have gone up. They're a bigger part of my portfolio now. They're 65% stocks, and I only have 35% bonds. Now, left unchecked, this actually could pose some threats to your investing philosophy or your investment strategy, because now, again, 3 years later, you have 65% stocks. You're actually taking more stock risk than what you set out to do originally. So the concept of rebalancing is taking some of that 65% that are now in stocks, maybe 15%, and selling that because it's done well the past few years. We're going to sell what's been doing well, and we're going to rebalance that back into the fixed income to bring it back to the 50-50 type of portfolio, which is your long-term strategic target allocation. And when we do this rebalancing technique, we don't wait 3 years. We do it quite frequently, and where we're seeing dips into the market, maybe there's a global pandemic and there's an opportunity for the market to go down, and now bonds are more of the portfolio than stocks. We'll sell some of the bonds and buy into the stocks. And what that does is provide us a mechanism, a prudent way, a disciplined way to stay invested, so that when times are good, we will sell what's been doing well, and we'll buy what's been doing not as well. And that is the old buy low and sell high. And that, if you can do that, that will lead to long-term positive returns and on your way to achieving your goals through your investments.
Well, thank you, Matt. We promised to keep it to 30 minutes, and we have a minute for questions. If anyone would like to ask any questions, again, you can use the questions box in the meeting tool here. One of the questions, Matt, while we wait for some other questions that did come up earlier, was about day trading. So the question is, what is day trading, and should I be doing it?
All right, so you're speaking to someone with experience in day trading. At the beginning of my career, I did start as a day trader, and what that means is that you're really investing for very short periods of times. It could be 1 day, it could be 1 hour, or it could be even 15 minutes. It's really short-term trading, and the goal of it is to obviously make quick profits and then move on to the next investment. And so When we think about investing, we think about long-term investing, and what we were talking about today. The time horizons of 5 or 10 or 15 years is very much different than a 15-minute or 1 hour time frame to invest. So day trading is I would say, more speculative. That is, it comes in with great risk and could be great rewards, but over the long term, there's studies that say and have found that day trading and trying to time the market, because you're trying to time when to buy and when to sell and get that right over and over and over again from day to day, is a very difficult thing to do, next to impossible to do that consistently. Now, of course, you could follow a stock and buy it low and sell it high, and that goes kind of to the emotional part of investing, where, okay, I've done it, I know how to do this, and then you go and you buy something that you may think is a good investment, but you know, for whatever reason, either the economy turns over or the individual company itself does not as well. So there's the risk there. So should you be doing it? I don't think you should be doing it with your long-term money. It's getting easier to do it because of some of the trading apps that you can trade from the comfort of your home or the comfort of your smartphone, and so it's more accessible. If you wanted to try it, I would urge you to just start with a very small amount of money, and know that that is your money. That's if you lost it, you're okay with it. This is not your long-term retirement type money.
Great. Well, thanks, Matt. We're out of time. Appreciate the wisdom that you shared with us today. Hopefully, those on the line here were able to learn something. As a reminder, we will be sending out a recording of today's session. So, you know, again, if there's anyone, you know, in your circle, family or friends that just wants to learn a little bit more about investing, you know, feel free to forward that to them. They're more than welcome to you know, download the recording and watch it. So thanks again, Matt. Thanks everyone for attending today, and have a wonderful rest of your day.
Thank you.